The architecture of trade finance, understanding margin, letters of credit, and the illusion of disappearing capital. Introduction, where perception breaks from financial reality. In small and medium trading businesses, particularly those dealing in imported goods such as second-hand garments, the language used within families often diverges sharply from formal financing terminology. Statements such as 1 crore of capital is gone or money is stuck are not literal description of losses but reflections of liquid stress, timing mismatch, and the structural realities of trade finance. At the center of this confusion lies the concept of letter of credit (LC margin), a mechanism that appears simple on the surface, akin to a down payment, but in reality functions as a sophisticated instrument of risk allocation between importer, bank, and exporter. Understanding this system requires abandoning intuitive linear thinking about money and instead adopting a dynamic, cycle-based view of capital. The letter of credit, a contrast of trust across distance. A letter of credit is not merely a payment method, it is a contractual guarantee issued by a bank that substitutes the creditworthiness of the importer with that of the bank. In international trade, where the exporter and the importer often operate in different legal and informational environments, trust is scarce and risk is high. The LC resolves this by assuring the exporter that the payment will be made upon presentation of compliant documents, regardless of the importer's subsequent financial conditions. In effect, the bank becomes the counterparty to the exporter, and the importer becomes indebted to the bank. This arrangement fundamentally alters the flow of risk. The exporter bears shipment and quality risk. The banks bear payment risk conditional on documentation. The importer bears ultimate financial liability. The LC is therefore less a financing tool and more a risk transfer mechanism that enables trade to occur at scale. The nature of margin, collateral, not cost. The margin required by the bank while operating an LC is often misunderstood as a partial payment for goods. In reality, it is a form of collateral, an upfront deposit that serves as a buffer against default. When an importer deposits, for instance, 10% of the LC value, the amount isn't applied towards the purchase price in a conventional sense. Instead, it is held by the bank as security, ensuring that the importer has both the capacity and the incentive to honor the full obligation. The critical distinction is that margin doesn't reduce the importer's liability. If the LC is for 50 lakh and the margin is 5 lakhs, the importer is still responsible for paying the full 50 lakh when the payment becomes due. The margin merely reduces the bank's exposure and signals the importer's commitment. From a capital perspective, the margin is immobilized immediately, while the remaining amount becomes due upon document presentation or within a short financing window. Payment obligation and the collapse of the margin illusion. Once the exporter ships the goods and submits the required documents, the bank verifies compliance and proceeds to honor the LC. At this stage, the importer must either pay the remaining amount immediately or convert the obligation into a short-term loan. In either case, the importer is now financially responsible for the entire value of the goods. The earlier notion that only the margin represents investment collapses at this point because the importer's capital, either directly or through borrowed funds, has now been fully deployed. Thus, even a single transaction, the importer's exposure is not limited to the margin but extends to the entire invoice value. The margin is merely the entry ticket into the transaction, not the total cost of participation. The cash conversion cycle, where capital gets trapped. The true source of confusion, however, doesn't lie in the LC itself, but in the cash conversion cycle. In business, dealing with seasonal goods such as winter garments, where winter fruits, seasonal vegetables, pulses, rices, sugar, and other commodities, the timeline between import and final cash realization is extended and not linear. Goods imported in August may not be sold to end customers until November through March. Furthermore, the importer often sells these goods to wholesalers on credit, meaning that even the goods leave the warehouse, cash is not immediately received. This creates a multi-stage delay. First, capital is converted into inventory, then inventory is converted into receivables. Only after a significant lag are receivables converted back into cash. During this entire period, the original capital remains locked within the system, unavailable for reuse. The multiplication of exposure through overlapping cycles, the most critical factor and the one that explains the perception of an amount getting stuck, is the existence of overlapping trade cycles. A trader doesn't wait for one shipment to complete its full cycle before initiating the next. Doing so would drastically reduce turnover and profitability. Instead, new LCs are opened while previous shipments are still unpaid. This creates a pipeline of obligations, each at different stage of a cycle. If one shipment of 50 lakh or 30 lakh is imported in August, another shipment is done in September. Both may remain unpaid until the winter selling for that seasonal good concludes. At that point, the trader has an amount of 1 crore of capital tied up across two shipments. Even though each individual transaction is only 50 lakhs, the exposure is cumulative, not isolated. This is the structural reason why large amount of capital is considered stuck in this entire system. They are observing the aggregate effect of multiple concurrent commitments, not the cost of a single transaction. Revenue versus liquidity, the cost distinction. Another layer of misunderstanding arises from the conflation of revenue with liquidity. When goods are sold on credit, revenue is recognized. Profits may even be calculated on paper. However, no cash has yet been received. The business appears profitable in accounting terms but remains constrained in operational terms due to lack of liquid funds. In the example where the goods costing 50 lakhs are sold for 1 crore, the trader has effectively created a receivable of 1 crore. Until that receivable is collected, the business cannot use those funds to repay obligations or finance new imports. The money exists as a claim, not as usable capital. This distinction becomes accurate, and cash is fundamental to understanding why large sums of money can appear to vanish despite successful sales. The psychological framing of capital gone. Within informal discourse, especially among non-financial stakeholders, liquidity constraints are often described in absolute terms. When cash is not available, it is perceived as lost, even if it is merely delayed. This psychological framing simplifies a complex reality that can be held to persistent confusion. When a trader says that 1 crore is gone, he is not reporting a loss but expressing that 1 crore is currently inaccessible. Due to its entrampment in inventory and receivables, this language reflects operational stress rather than financial failure. It signals that the business is fully leveraged within its working capital cycle and has limited flexibility to absorb shocks such as delayed payment or unexpected costs. Risk concentration and system fragility. The model described as inherently leveraged and therefore sensitive to disruptions. If buyers delay payment beyond the expected cycle, the importer may face difficulty meeting bank obligations. If goods are damaged, mispriced, or unsold, the expected cash inflow may not materialize. Currency fluctuations, port delays, and changes in demand further compound the entire risk vector. Because multiple cycles are stacked, a failure in one segment can cascade through the entire system. The trader's capital is not diversified across independent investments, but concentrated within a tightly coupled pipeline. This amplifies both potential returns and potential losses. Conclusion from linear thinking to a systematic functioning structure. The confusion around LC margin and stuck capital arises from applying linear logic to a system that operates in cycles and overlaps. A single transaction doesn't define exposure, the aggregate of concurrent transactions does. Margin is not a partial payment or a security mechanism. Profits doesn't equate to liquidity. Revenue doesn't imply cash availability. Capital doesn't disappear, it becomes temporarily immobilized within the structure of trade. To understand such a business, one must shift from thinking in terms of isolated events to thinking in terms of flow, timing, and interdependence. Only then does a statement that 1 crore is stuck, or this amount is stuck, or this amount or liquidity crunch can be understood in a better fashion.